Okay, let's dive into this. Welcome to today's explainer. We're doing something really fun today. We are taking a dense, totally data-packed earnings report from Lakeland Industries, and we're going to decode it. We're looking to see if we can spot a real-time corporate transformation. Because looking at their first quarter fiscal 2027 results, man, this isn't just a story about numbers. It's really a story about a company fundamentally trying to change its DNA. So let's unpack this fascinating pivot together. To do that, here's our roadmap for the explainer. We're going to break this down into 5 digestible chapters. First, we'll look at the Q1 financial overview. Second, we'll see how fire services lead the way. Third, we're diving into their new recurring service model. Fourth, strategic divestitures and cleanup. And finally, number 5, looking ahead to FY27. All right, let's jump right into Chapter 1, the Q1 financial overview, setting up the baseline report card before we dive below the surface. So, obviously, we've got to look at the top-line numbers first. $47.4 million, that is the net sales figure for the first quarter. It represents a modest, but hey, steady 1.4% increase year over year. But you know how we do things in these explainers. That top-line number, it's really just the tip of the iceberg. It definitely shows us the impressive scale of Q1, and it shows they're growing despite some macroeconomic headwinds, but it absolutely doesn't tell us the full story of their underlying profitability. The real story is this whopping 79.6% year-over-year jump in adjusted EBITDA, excluding foreign exchange. That brings the figure up to $1.1 million. By stripping out those kind of unpredictable currency fluctuations, we get a way clearer picture of their core operational health. And honestly, that's exactly what investors are looking for. It highlights some serious, immediate profitability momentum. So while top-line sales grew modestly, their operational profitability almost doubled because they tightened up working capital discipline and slashed operating expenses by $1 million. Now, what's really interesting about this revenue breakdown is where that money actually comes from today. Because the structural shift is just undeniable. Nearly half, a massive 49%, is now dominated by fire services. Disposables are sitting at 29%, and industrial, performance chemical, and high visibility make up the remaining 22%. They are really increasingly becoming a highly specialized fire safety company. Which brings us perfectly to Chapter 2, Fire Services Lead the Way, shifting focus to the absolute fastest growing part of their business. Before we get too lost in the spreadsheets, it's absolutely crucial to ground ourselves in reality here. We are talking about serious, literal, life-saving protective gear worn in some of the most hostile environments imaginable. And the global market for this gear, it's highly active. In fact, the fire services segment just saw an awesome 11% jump to $23.4 million in the quarter. It is clearly carrying the weight of the company's growth right now. A massive driver of this momentum is what management calls their head-to-toe strategy. They've essentially built a fully certified, single-source suite of products under the incredibly stringent new NFPA 1970 standards. That's basically the gold standard for emergency responder safety. We're talking Pacific brand helmets, turnout gear from Lakeland and Veridian, Jolly boots, and Veridian gloves and hoods. By having all of this under one roof, Lakeland has carved out a massive global competitive advantage. Think about it. Fire departments don't want to piece together a safety suit from a dozen different vendors. They want one complete, reliable solution from one global provider. So the crucial point is the stark contrast between these two markets. On one hand, the fire segment is booming. You've got high global tender activity, that 11% growth we just mentioned, and huge showcases at industry events. But contrast that with the U.S. industrial and disposables market. Management actually notes that this side is currently soft. They're kind of awaiting a broader economic recovery and seeing pretty flat turnaround activity. You know, those times when refineries shut down for planned maintenance. So, leaning heavily into fire, it's not just a fun little pivot. It is a strategic necessity to keep things moving while industrial markets normalize. All right, moving on to Chapter 3, the recurring service model. This is where things get really cool, changing from just selling products to building a service engine. This represents a massive shift in their corporate DNA. They're moving from a sell-it-once-and-walk-away model to a recurring, sticky service loop. It's called the Independent Service Provider, or ISP, lifecycle. It loops continuously: inspection, cleaning, repair, and rental. It's brilliant. Instead of making a sale and not talking to the customer for 5 years, Lakeland creates these continuous, high-margin touchpoints with fire departments. That means consistent recurring revenue, and it deeply, deeply entrenches Lakeland into the daily operations of their customers. In the cleaning part, they aren't just throwing these heavy, toxic suits into a giant washing machine anymore. Just listen to this quote from the report. Unlike traditional wash-only service models, Integrating CO2 cleaning allows us to offer a more advanced decontamination solution. They just rolled out this new CO2 technology in their Fresno, California facility. It removes harmful contaminants way faster, it's better for the garments, and it significantly deepens customer retention. They're basically offering a premium, high-tech service that traditional wash-only competitors literally can't match. Chapter 4. Strategic Divestitures and Cleanup. How exactly are they paying for all of this? Building out new high-tech facilities across the country obviously takes capital, and this brilliantly illustrates exactly how they funded it. Check out this capital allocation shift. They generated $13.2 million by selling off non-core product lines, like their high-performance, fire-resistant, and high-visibility gear. And they took that cash and directly reinvested it into expanding those high-margin recurring revenue hubs we literally just talked about. New ISP facilities in Denver, Phoenix, and Fresno. It is a textbook example of selling off the past to fund the high-growth engines of the future. Now there's a parallel corporate cleanup happening internationally too. Over in Europe, they're aggressively transitioning their LHD brand. They shifted German operations to a third-party logistics model to save some cash. They onboarded fresh commercial sales talent, right-sized the operations, and they're prepping to completely relaunch the brand at Interschutz 2026. Management is being super transparent here. They're framing Q1 and Q2 as transitional periods in Europe so they can build a much stronger, more profitable brand for the back half of the year. Which leads us to our final section, Chapter 5, looking ahead to FY27. What should we expect next? Let's move to and see how this builds across the globe versus internal expectations. So, the US is currently undergoing a sales motion reset and is performing below plan. But look at the international markets. They are crushing it. Asia is at 132% of plan, and Latin America is hitting 119%, driven by big new orders for Mexico down to Argentina. These massive international beats are effectively buffering that US reset, keeping the overall company's forward momentum going strong. So, what are the specific catalysts management expects will drive high single-digit revenue growth and margin expansion as the rest of the year plays out? Well, first, their US fire business backlog is already exceeding their Q2 budget. Second, the global tender pipeline for that certified head-to-toe gear, it's building rapidly. Third, margins are expected to improve as they get more volume scale and expand that high-margin service revenue. And finally, their Eagle Technical Products subsidiary just got notified of an intended award under a UK framework. We're talking a total potential value of up to £220 million over 7 years across all suppliers. That is a massive, massive long-term pipeline. We have covered a ton of ground in this explainer today, haven't we? From margin improvements and strategic divestitures, all the way to a major operational shift into CO2 decontamination services. Which really leaves us with one overarching question to ponder. With a fortified balance sheet and a comprehensive head-to-toe strategy, will Lakeland's pivot to recurring services be the spark that ignites long-term compounding growth? It's a truly fascinating narrative of corporate transformation, and I highly encourage you to keep an eye on their data to see how this all plays out. Thanks so much for joining me to decode this, and I will see you on the next explainer.